Hey, and welcome to my channel Fiscal Voyage. I'm Felix, and today we're going to talk about a company that I personally own in my portfolio, and I think that it's worthy to watch this video and see if it's worthy to you to own it as well. So in this video, we're going to talk about General Dynamics Corporation and determine if the stock is a buy, sell, or hold at current prices. Since the coronavirus pandemic, a lot of the stock market has been dropped tremendously and bringing a lot of companies in undervalued territory. So in this video, we're going to determine how far undervalued or even is it undervalued the General Dynamics share price is. So let's start. All right, so let's start with the stock analysis on General Dynamics Corporation. The company is a American Aerospace and Defense Corporation, and as of 2019, it is the fifth largest defense contractor in the United States and the sixth largest in the world by sales. The company ranked number 92 in the 2019 Fortune 500 list of the largest U.S. corporation by total revenue, and it is headquartered in Reston, Fairfax County, Virginia. All right, let's look at the fundamentals. From 2010 to 2019, the company grew revenue at 2.16%, which is very mediocre. I like to see company 4%, 5%, 6% revenue growth. However, the past 5 years been better at 5.75%. Net income at the same time period, 2010 to 2019, grew at 3.20%, which is a little better than the 2.16. And the credit rating for the company is A, which is investment grade and is outstanding. So then the chances of the company going to bankruptcy is very, very low. Operating income grew from 2010 to 2019 at 11.8%, and earnings per share grew at 6.46, which is quite interesting considering the dividend growth, and we'll get to that in the next slide. And the last 5 year earnings growth grew at 7.17%. And for 2019, adjusted earnings per share was $11.98, net margin at 8.85%, which has been compressing over the past 4 years from 10%, 9%, so it's been dropping the past 4 years. Return on equity is very nice at 27%. Debt to cap is low at 37%. And the current yield is a decent yield at 3.18%, which is slightly higher than the broader market. And they have a great payout ratio of only 34%. So the dividend is very safe, and at 34%, that gives us opportunity for more dividend growth. And speaking of dividend growth, the company has been growing it for 25 consecutive years, and the last 5 year dividend growth rate is 10.52%. In the previous slide, we said that the earnings growth was between 6 and 7%. So they've been growing dividends at a higher rate than earnings, which is interesting. But they have a low payout ratio to continue this going forward. The most recent dividend increase was 7.8% on March 4th. This might have been because of the coronavirus pandemic, so they were probably being conservative here. The company has a 5 year dividend yield average of 1.95%, so you could get it now at 3.18. So that means based on yield that is undervalued based on its 5 year average. And the company has a Chowder rule of 13.7, which is the 5 year growth rate plus the current yield, which is great. You'd like to see it 12 or higher, and we're getting a 13.7. Future outlook. Analysts expect 2020 to come in at $11.90, which is lower than last year's $11.98. But I don't see that hurting the company stock price because it's such a defensive company and high quality company that I don't think it should drop the stock price any further than where it is now. 2021 is going to jump higher to $13.10. So 2021 is where they're going to see some good growth of almost 10%. And CFRA projects 3 year growth rate of 9%. And my dividend yield return model came in at 13.7%. So basically this return model is predicting almost 14% in annually rated return. So that's outstanding. I like that. Forward PE is at 10.96, and currently the PE is at 11.5. So that looks promising. And the 5-year PE average is 17. So based on the PE, it looks like the company is undervalued. So we look at the fast graph here. The black line is the monthly closing price. The orange is the earnings based on a 15 multiple, and the blue line is the normal PE. The stock tends to follow between the 15 PE and 16 PE. So, but like I said, right now you're getting it at a 11 blended PE. So that's undervalued based on his fair history. So let's determine the fair price. CFRA has at $137 as its fair price, Morningstar at $195, FastGraph at $178, Yahoo at $181, and my dividend discount model analysis at $156. Averaging out the 5, we get a fair price of $169.82. Based on current price as of April 18, $138. The company is undervalued by 22.8%. So that's great. I like to see companies undervalued by 10% at least. That gives me a margin of safety. So with that, I recommend this company as a buy at current prices. I actually own this company. It's a great company to own. During the recession of 2008, 2009, they were still growing the dividends even though earnings were a little flat. They have a 25-year dividend growth record of increases and a great 7 to 10% of dividend growth am I expected in the future, in the coming years. The only drawback I see is that the company relies a lot on the U.S. government for revenue. 66% of the company revenue is from the U.S. government, so that's a little concerning because basically the government could maybe pick another company to build their machine guns and things like that, the military defense projects and stuff. So that's quite concerning. However, I still recommend it as a buy. I currently own it in my portfolio, and I think you guys should take a look at this company right now when you get the chance. So with that, if you have a company you would like to see next, please let me know the name of the company and ticker symbol in the comments. Thank you for watching, and if you find this video informative, please hit the like button and subscribe to my channel for more videos like this. Don't forget to check out my portfolio. The link is in the description below. Have a great one, guys. Stay safe.